How to withdraw money from a limited company for personal use. A Pty limited company is a separate legal entity, and thus all the money and assets belong to the company as opposed to the shareholders or the owners. This means you cannot simply take money out of a limited company bank account and use it for personal use. There are tax implications which may result in you paying the highest marginal tax rate of 47%, which includes the Medicare levy. There are a few methods, though, of taking money out of the company correctly, depending on the situation. As a director of a Pty limited company, there are 4 common ways to withdraw money from the company. Each method is quite different in terms of tax implications, and thus you should consult your accountant before planning to withdraw money from the company. These 4 methods are: 1. Director's salary, wages, or director's fees. Number 2. A dividend payment. Number 3. Director loans. And number 4. Expense reimbursements for directors. Firstly, let's look at director's salary, wages, or director's fees. Drawing a salary, wage, or director's fee is the most simple and common method of taking money out of a limited company. This will mean the company will become the employer and withhold tax and pay the director's compulsory superannuation. The payments will be tax deductible for the company, and the payment will be included in the director's income tax return for the financial year, meaning the director will be paying the tax on the salary, wages, and fees, and not the company. Next, let's look at expense reimbursements for directors. Another way of taking money out of a limited company is through expense reimbursement for directors. If the director is paid for expenses on behalf of the company in the course of exclusively running the business, then the company is able to repay these amounts without attracting any additional tax. Another option is the dividend payment. If you run a contractor business, the director will likely be the shareholder of the company. Directors can also pay themselves dividends, which can formulate a method of taking money out of a limited company. The dividend can be fully franked, which means the company has paid tax on the retained profit, or unfranked, meaning no tax has been paid on the retained profit. The dividends can be paid at the end of the financial year or at different times throughout the year. The great benefit of dividends is that they are not subject to superannuation, payroll tax, or workers' compensation. Finally, director's loan. The director's loan is another method of taking money out of a limited company. As the name suggests, the director's loan is a loan from the company to the director. The director can borrow money from the company or vice versa. It's quite common for the director to borrow funds from the company. In this case, there is no need to withhold any tax from the payment as it is a loan. There are other implications on this method, however, which depends on the length of the director's loan and whether the director owes the company or the company owes the director. If the company owes the director at the end of the financial year, then there are no complicated implications if the money is withdrawn. A specialist accountant would be able to advise you on how to deal with the situations discussed above. Thank you for watching this video. If you have any questions or require further information, please contact RNO Financial on 9829 5666.